Hi friends, I'm back with one more video. So today we will be discussing about the IV, which stands for implied volatility. So before watching this video, I would recommend you to watch the video what I've made on ABCD of delta, then ABCD of theta, and this would be like ABCD of the IV, and then followed by ABCD of your vega, and then ABCD of gamma. So by this we will be like concluding the major part on the Greeks. All right, let me take you to back to this page. Okay, so what is basically IV, right? So every time when we discuss about IV, so we always have this VIX into consideration. So let's talk about what is IV. See, IV, I'm not trying to give you the textbook definition, which I'm not good, you all know. See, IV, basically IV is for the individual strikes, right? If you look at the option chain, we have individual strikes, right? I mean, if you look at the bank nifty, we have 100 difference of strikes. If you look at the nifty, we have like 50 difference of strikes. So this IV refers to individual strikes. That's it. This IV refers to individual strike. Let's say 36,000 strike will have different IV, 36,500 will have different IV. Let's talk about nifty 16,000 will have different IV. So this is more related to your strike price. Okay, so when we talk about VIX, I've already made a video on VIX, right? Again, I'll reiterate. VIX, generally we correlate VIX with the overall market, right? When we say overall market, we have a VIX chart also, right? Altogether we have the VIX chart. So IV is for the individual strikes and VIX is for the overall market. Got it? So when we say VIX is high, right, so that will have impact on the overall market, on the nifty and bank nifty, but IV has the impact only on that particular strike. So will it be okay if I say, let's say if the VIX is standing, we know the level, right? VIX stands from majority of the time from 10 to 30, right? This is the majority, then maybe 10 to 14 and 14 to 20, right, and 20 to 30. So majority of the times the VIX will play between 14 and 20. We all know that. So is it right if I say if the VIX is between 14 to 20, the IV will also be between 14 to 20 of that particular strike? No, absolutely no. Can I take the other way? Let's say the IV is standing at 14 to 20. Let's say one of the strike wherein the IV stands at 14 to 20. So can we say that the VIX will also stand at 14 to 20? Absolutely no. So both are independent, right? The levels of VIX is, as I mentioned, 10 to 30, but the level of IV can deviate. Okay, so when the VIX stands at 30, it is not mandatory that IV of any particular strike, be it ATM or be it in the money, that will also stand at 30. No. So it all depends on the VIX, right? So it can stand at 100, it can stand at 50, it can stand at 80, right? It can stand at 130. It all depends on the VIX. So both do not, see friends, one second, someone is at my door. Okay, so now what I meant to say is, right, both are interrelated, but we cannot say that if the VIX stands at 30, IV will also stand at 30. So right, I'll show you all practical examples also. So we have discussed about the basic difference about IV and VIX. Net the conclusion is IV is pertaining to your individual strikes, VIX pertains to your overall market structure. All right, so let me take you to the next page. Okay, let me delete this. Okay, I'll show you this example. Let me take you to what is that? Let me take you to the trading view. Okay, so this is the IV. This is the India VIX, what I was referring to. So I'm at the daytime. So you check the VIX. What did I say? The VIX stands at, even if I draw a line somewhere here, right? See, you have a, let me take it to 10, right? Majority of the time. So let me take it to 10 so that it will like easy for you to understand, right? So the VIX is at 10. So check this date. On 7th Jan or on 25th February. Let's take an example of what is this? Maybe 7th Jan till, right, 21st Jan. The VIX was standing at 10, right? Do you see this level? 10. But if I plot this, right, maybe somewhere in the month of March, the VIX was standing at 84. Right, VIX was standing at 84, but the VIX was standing at 10. during the Jan month. You know, right? This was the period of the COVID. Right, the moment we see spike in the IV, we know that this was the COVID time. That's the reason there was a huge spike in the IV. So what I'll do, I'll take it to the Obstra. All right, I'll take it to the Obstra. I've had this simulation. So what I'm trying to show is, like, I'm just trying to show you the IV, right? The IV of 2nd Jan, and this is 38th. What is this? 1st of Jan. Sorry, 30th of Jan 2020, and the start is 2nd of Jan. I'm just trying to show you the IV during this period so that you'll get a more clarity. Okay, the market was standing somewhere at what is that, 32,377. Check the IVs. Put IV 17, 17, 16, 15. What did I say? When the IV stands at 10, right, it doesn't mean that, sorry, when the VIX stands at 10, right, 10 and between, that doesn't mean that the IV will also. See, check the IV 17, 17. So every individual strike will have different IVs. So where is the market standing? 32,300, right? So where is 32? So this is your at the money, right? Check your IV, right? 13, right? 13, 13. IV keeps on increasing, right? Check the IV on the call side. See, call side IVs. See, where is that IV? On the call side IV, this is your independence 13, 13. Say, as and when we go OTM, the IV will reduce. We all know that as and when we go in the money, right? So just check the difference, 17, 17, and overall an average of 15 to 17, right? So not what I'll try to do. I'll take you to this period. Maybe I'll take you to March expiry. Okay, from Jan I'll take you to March just to show you the difference. March, I will take at 26th March, and this I'll take you to maybe let's take it this one, first week of March. Okay, even I'll just try to make it to 31st March, right? 26th March. Check the IVs, friend, right? Check the IV, like 33, from 14 to 15 it has increased to 33, 32, and check the IV on the call side, right? 23, 22. So now the moment I take you to, let me take you to the 12th March, right? See, the IVs have spiked from 10, 12 to 30, from 30 to again like 50, 49. And what I'll do, I'll just try to increase, start with 19th, right? Check the IVs, 109, 101, 77, right? Do you see that on the call side also? 104, 90, 107, all the 3 digits IVs, and also on the put side you see all the 3 digit numbers. But where is your IV? Where is your VIX standing? Your VIX is standing somewhere at like 72 to 84, but your IV is at 109, 101, right? You check your this thing, 152. At one time it went to 152, 113. So both your IV and VIX, though they are interrelated, but this is more, your IV is more specific to the strike rates and your VIX is more specific to your overall market. Okay, so this is what I was trying to convince you. What is the IV and the VIX? Okay, so IV is pertaining to your strikes, individual strike, and this is pertaining. So now let me go take you to IV. This slide is very important. Okay, so whenever we say IV, right, that is high premium. We all know whenever the IV is high, the premium will be high. Or else I would say, if I replace it with VIX, high IV or high VIX, it would be high premium. Medium IV or medium VIX would be medium premiums. Low IV or low VIX would be low premiums, right? We will talk with regard to IV now. Okay, so what is the one thing which the option seller requires? Obviously high premiums. If I am an option seller, I want high premium, so then only my profitability will be more. I'll get more range in case if I'm going for strangle or iron fly or straddle, right? So whenever the IV is high, I'll get high premium. High premium is high profit. High premium is equal to high range. Okay, so do you think whenever the IV is high, as an option seller, should I feel comfortable or should I feel like into panic situation because high IV, right? Obviously I should feel in a comfortable position only when the IV is high, right? This is very important to understand. I've already made a video also. When the IV is high, and from there the IV should fall down. This combination we need, right? IV plus, we want, the moment we deploy the trade, we need high IV, point number 1, and from there the IV should decline. That is the best combination for the option seller. Whenever the IV is low, what do we need? Low IV is low premium is low range, low premium is equal to low profit, because whenever we wanted to go for like iron fly, we let's say this is your current market, we have to go very close to your current market price, because we are getting low premium. So when we go very close to your current market, we have to become very aggressive. Just a move of 1% here or 1% here will get you into the panic situation. If you make a bigger iron fly, right? I mean, maybe this is, I'm just telling you, straddle. If you make the bigger straddle, your market stands here, you have to go very far away from the market, very far away from the market, so your profit will be only very low. You got my point? So this has the consequences. So now what you have to do is, whenever the IV is low, okay, so then we need to deploy what? We need to deploy the calendar spread. See, I'm just see, again I've made it 35-40 minutes of video on the VIX. I'm just reiterating, right? I'm not going to tell all the video. So whenever the VIX is low, we should not think about iron fly, we should go for calendars, because VIX is low, there is a maximum more probability of VIX going high. Got it? So when we go for calendar, what does the calendar requires? We have the next week edges, right? So this increasing VIX will increase the premium of the next week calendar edges, so you'll get into profit. If you're planning to go for iron fly here, with the increasing VIX, your iron fly will give you in the panic. But definitely this, we need iron fly, but the VIX has to fall from there, right? We have discussed about IV, we have discussed about low IV. Medium IV, this is a very tricky, and this is what majority of the option seller wants. This is very tricky. So medium, like even this can go up from here, the IV can go up, or the IV can come down. So you have to be like very much what do you say, you have to be like very smart trader in terms of deploying your trade. Either you can go for iron fly with calendar edges, right? When you see that VIX might go up, go for iron fly with the calendar edges. When you think that VIX will come down, you have to go for iron fly. I'm just telling you only 1 or 2 trades, because I've already made a very detailed video. I'll try to put it in the description, you can watch that video. That's the VIX based strategies, right? So we have discussed about high IV, medium IV and low IV. So whenever you look at the IV, you have to double check with yourself, saying that, boss, do I need to go for calendar? Do I need to go for iron fly with calendars, or do I need to go for plain iron fly, or else do I need to go for iron fly here, or do I need to? So you cannot go for calendars here when the VIX is high, right? Because if the IV falls, your calendar will give you huge loss, right? So this is all judgmental. Okay, I'll just leave it to you. Now I'll show you something practical. Okay, so we have discussed about this thing. So let me take you to sensible. Okay, let me take you to the sensible. So now what I'll try to do is, let me take a triangle, right? Let me take a triangle. Okay, so now if you look at the, see, if you look at the IV, right, both your 38,900 and 39,900 have the similar IV, right? 30 and 30, right? Tell me one thing, right? These two have similar IVs, right? So tell me one thing, what did I say? Whenever the IV is high, right, your premium should be high. Absolutely right, your premium should be high. So what is the premium of 38,900 here? 80 rupees. And what is the premium of 39,900 here? 112. But the premium is, the IV is more or less same. So what I'll try to do is, like, see, whenever we have high premium, right, theta should also be more, right? So what I'll try to do, so there is a direct correlation between your IV and the theta. See, now I'll try to explain you, right? See, check this premium, right? 82 for 38,900 and 92. I'll just try to increase the IV. Manually, I'll try to increase the IV. Just keep an eye on this theta, right? See, 31, I'll just increase to 32. Your IV, your theta is increasing, right? I'll go to, let's see, I'll take you to 36. I'm just trying to see now. As and when the IV is increasing, your theta is also increasing, because what is the relation between IV and the theta, right? IV is what? I premium. So I premium is like high theta. Okay, so now again I'll take you to 40, right? I'm just trying to simulate, and as and when I'm taking the VIX to higher, sorry, the IV to higher, the theta is also going upside. So what did you understand from this thing? Right, we have proven that IV is, right, I premium. See, I'm not manipulating the price over here because I cannot do that, but I'm just showing you with the theta, high theta. And tell me one thing, right, there is one of the differentiator now. Let's say this is your trade. Let's say this is, forget that I've manipulated the high V. Let's say this is your original trade, friends. This is your original trade, right? Theta of 38,900 is 113 and theta of 39,900 is 91 rupees. So let's say tomorrow market opens flat. So let's say tomorrow market opens flat, right? Do you think which theta will go closer to 0 on the expiry? Let's take over, this is your expiry day. Tomorrow is the expiry day. Your theta of 38,900 is at 113. Your theta of 91 at strike 39,900 is at 91, and this is your high V. And let's say tomorrow market opens flat. Which theta will give you more decay? Just pause the video and give it a thought, because tomorrow is the expiry day. Obviously, right, obviously this will give you more decay because this has high theta, this has low theta. What do we understand? We have seen the theta graph, right? The theta time graph will be something like this, right? This is your Wednesday, you know, right? Thursday, Friday, Monday, Tuesday, Wednesday and Thursday. So we are discussing, we are at the Wednesday end of the day here. So that the next day morning, I'm asking you which theta will have more decay, right? Obviously this will become, this will decay, this will go to the 0 because this has to become 0, right? If this is like OTM, if this has to become 0, this will have more decay because this has more theta, right? Whenever this has more theta, so this will have more decay. So this will be like slow in terms of decay compared this 91. This particular strike decay will be less when compared to 114 38,900 because the theta of 38,900 is more. So this will go with a very speed in terms of 0 rather than this thing, because what did I say? The IV of this strike is more. So when we have high IV, that is high premium. So high premium is typically high theta, right? So whenever we have high theta, so this will go to 0 on the expiry day with a much quicker speed. But when compared to this 92, this will go to 0 with a less momentum when compared to 113. Got it, friends? So I think I was able to what do we say? I was able to deliver the content. If you are not able to understand, pause the video. See, whenever you deploy the trade, right, you need to know all this basics about the IV. See, blindly you cannot go ahead and just deploy the trade saying that one second, let me delete, right? So first you need to know what is the difference between IV and VIX. So I've just given you, and already I made a 35-40 minutes of video. You can watch that video, okay? And you should know what is implied volatility, right? And the other thing what I've not discussed with you is, let me show you. See, what does this IV mean? Okay, let me take you to Obstra, right? See, whenever we talk, or else let me take you to the sensible. See, what does this IV mean, friends? So let me reset this. Let me reset, right? This is my strangle position. So what is this 30.7 or 30 IV indicates? What does it mean? See, currently your premium is 80 rupees, right? And you have the 30 IV. So what does it mean? So this says that the market, right, if the IV stands at 30 rupees, it clearly says that this 80 rupees premium can become, say, what is, one second, let me show you, right? This is very important, friend. This is very important. See, volatility, what does volatility means, right? You know, right? Volatility is something like, this is volatility. It can go up, it can come down. It can go up, it can come down. The market stands here, right? It can go up from here, or else it can go up and it can also come and make a low here. So what does that mean? Your current market is standing here. So it has a potential of this 80 rupees premium can become 30 rupees. 80 plus, what is 30? 80 plus 30, this can become 110. Or else this can become 80 minus 30, this can become 50. I'm just giving you an example. So this is the volatility, meaning this 80 rupees premium can become 110 or can become 50. That is called the volatility. Hope you got my message, right? This is volatility. This is called the IV. This is called the, because this is what, right? So we cannot guarantee that this 80 rupees can become 110 or this 80 rupees can become 150 for 50, or else this 80 rupees can become like how much, 90 or 70. So this has the potential, basically. That's the IV. So whenever you look at any absolute figure, right, so you just try to understand that market, this particular price, this premium can become based on your IV, right? So this can become 110 or this can become 50. Same with this thing, 30. So this can become how much, 140. This can go for 140, and this can become minus 40 would be like your 80 or 70. That's the meaning of this IV, right? This is not a random number, so you have to just correlate this number with your premiums, because your IV, your Greeks and everything will have direct correlation with your price, with your premiums, right? This is one of the parameter. Your IV has an impact on your premiums too. Got it? This is what I wanted to convey, and I think this is more than sufficient for you to analyze your trades and everything. So this is all about the IV. All right. Thank you, friends.